Everybody, it's Brian Shannon from AlphaTrends.net. Today is Friday. It's the 18th of August, 2017, and we lost a little bit of ground in the markets this week, down at 0.5% for the S&P 500, and that brings the monthly loss down to just less than 2% so far. The Russell 2000, though, is the one that continues to be the laggard here, down 1%, close to 5% for the month, and just barely hanging on to positive year to date. So we had broad selling, and semiconductors actually held up a little bit, but let's take a look at the charts and make some sense of it all. The S&P 500 kind of looked like it wanted to hold up after this gap higher here on Monday, and then as we broke down below that support in the 5-day moving average, I had put on Twitter right in here that it looked like we had to be very defensive because the market was below the declining 5-day moving average, as well as below the volume weighted average price from this peak, that's this line right here, and below the volume weighted average price from this low, indicating that the sellers had regained control there. Today, I had pointed out on Twitter, if you're not following me on Twitter, and you're just listening to once a week video, you're missing out a lot. Anyways, from this peak to this low, we saw that was 248.91 to 243.70, and then from here, what we call this in a measured move, this is point A, this is point B. Point C, what we do is we take from this high right here, which was 247.57, and we subtract the distance from this, which was $5.21. That gave us a downward objective of 242.36, which is very close to today's low. And after that, it's really important to look at these levels. If you're an intermediate term trader, what we saw after that was that the volume weighted average price from the beginning of this move lower, that is the 2-day volume weighted average price, that's what I just put in right there, acted as resistance in here today, and then we did of course close below today's volume weighted average price as well, indicating that the sellers are still in control here. We had a bounce within a downtrend, and as I always say, the intermediate term time frame, we look at the direction of the 5-day moving average, and we look at rallies in when we have a declining 5-day moving average, we look at rallies as guilty till proven innocent. So heading into next week for the S&P 500, we can look at a daily chart with nothing on it so that we can take a closer look at some key volume weighted average price levels. We lost this level this week. That's not a good thing to see. That is the average price since that May low. Next up, we have this little low, which is just below, and you can see that that has also held as support previously. And if that fails to hold and we get a little bit deeper pullback intraday, then next week, I think that this is a likely area that the market is going to find a bounce area from. It's this prior resistance in here as well. So 240 to 241 will be a key level for this market to hold next week, and a possible area for it to make an intermediate term low. I'm not calling for that yet. We're going to have to look and see what the market gives us on a daily basis. We also broke, of course, the volume weighted average price since the beginning of the year, and that's not a good thing. That gets a lot of people's attention. And as I always point out, the break of a trend line doesn't mean a reversal necessarily, but it does mean that we have a slowing in the rate of ascent here. Now, if we're to get down to this level, let's just try to think a few steps ahead and bounce from there. Then if we were to see a rally that emerged like this, which then failed, well, we would have what would look like a left shoulder, a head, and a right shoulder. Let's not get too carried away with the bearish scenario though, because we are still above a rising 20, 30, and 40-week moving average. So a pullback should be just that, down towards 241. We will look for the potential of support. I don't think it's reasonable to panic and just throw stocks away. The NASDAQ lost some ground as well, and you can see here the trend line rather from the beginning of the year did hold for the NASDAQ. So, and we're down to what's been a pretty important level in the intermediate term. This prior resistance has held as support. Looking down to a 30-minute time frame, we are below the volume weighted average price from the July low, and we broke back below that. So it's very similar type of scenario that we broke below the volume weighted average price from the peak and from the recovery low, both in the same spot where that 5-day moving average is, and that's where we saw the unwind continue from. So we've got a 50-day moving average that's flattening out, and we're going to have to pay close attention. Now, the Russell 2000 is the biggest area of concern. What we have here is we know this market has been a laggard, and as we just saw on the spreadsheet here, we're only up 5 basis points year to date in the Russell 2000. We lost an important level this week, and that is that, we've spoken about the year to date volume weighted average price, how it's been kind of choppy back and forth, but the volume weighted average price all the way back since the election, since this rally began, the average price that the Russell 2000 has traded at is right now up here at about 136.10, or about $1.30 higher from where we are today, meaning that the average participant on the long side in the Russell 2000 is in a losing position. That skews the psychology negative and puts people really on the defensive. Now, here's what I think is a likely scenario for the Russell 2000. If we are to see next week a little bit of continued selling, I think that it's likely we continue slightly down through this March low. If we break that March low, I would, just by a few pennies, I would expect that we see a rally from there. In other words, I think there's a lot of stop losses under there. Those are an uneducated place to put a stop loss. My feeling is you should have been out as it broke support over here, which then turned into resistance. But what we often see is a cheap new low followed by a rally, and then if that rally were to be capped by the volume weighted average price since the election, then we could see the bigger unwind come. So time to be defensive in here. The semiconductors, as we noted, were up slightly this week, but we're looking at this again with no volume weighted average price, no moving averages, nothing on here other than price action. And now we'll draw on a trend line from the December low, and you can see that's maybe an important level. As long as we remain above here, we're still just kind of turning sideways, absorbing some gains. The biotechs, however, as we noted, we've been talking about the volume weighted average price since the election, how that held as an intraday support level after the year-to-date volume weighted average price was broken back here. And from that rally, what we had seen was what was looking like a nice sustainable breakout. But since that failed breakdown right in here, we've been observing this volume weighted average price, and what we saw was that not only is it found resistance right in there at that price action. Let's drill down to a 65-minute chart. So these are constructive 65-minute candles. That is, each one in here represents 65 minutes. The reason for that is because we have equal periods throughout the day. We have an equal number of 65-minute periods, that is 6 per day. So we have a declining 5-day moving average. That tells us that, again, we didn't trust this rally over here, and we didn't trust this rally either. We were looking at it earlier in the week as maybe it can find support at this 5-day moving average in reverse, but instead we saw that volume weighted average price acted as resistance, and now we have another lower low in the biotechs, telling me that the intermediate term trend remains lower in here. On the daily time frame, we've still got a rising 50-day moving average, and we've got this bigger area of prior resistance. So it's really tricky in here. For me, I'm on the sidelines in regards to the biotechs. I don't think it's time to be a buyer. Not yet. If we are to see that the biotechs are to reverse, I think it would look something like this, and then we would want to get long on strength above a flat to rising 5-day moving average. We don't have any of those signs, obviously. And let me talk again about the financial stocks, because I've seen a lot of people, not so much this past week, but as I've pointed out back in here, I said do not trust the people who tell you that the financials have turned higher. Not the financials, I did that again, didn't I? The energy stocks. Do not trust the people that say the energy stocks have turned or ready to turn. We have a declining 50-day moving average, and when the 50-day moving average is declining, stocks are considered guilty till proven innocent. Be sure to look at the Alpha Trends website and Twitter this week, because I will be doing a free webinar with my friends at Trade Ideas next week. That'll be next Thursday. So take a look and enjoy your weekend.